Hello, ladies and gentlemen. Thank you very much for joining us in this webinar on the Hack Fund by Hackers and Founders. We're very excited about this product. We're very excited about changing how venture capital works and essentially kind of debugging the system, which we've heard of the problems and the complaints of thousands of entrepreneurs as well as thousands of investors about investing in startups. And so we're going to talk a little bit about the mechanics of the fund today, especially on how it actually works. It might be a little bit confusing to you if you're thinking that this is kind of structured like a normal venture fund, or if you are not used to investing in like a mutual fund or an ETF in the stock market, it might be a little bit confusing to you there. We're kind of combining the two. So in a nutshell, you can think of the Hack token as a digital stock certificate. You can think of it as one Hack token is one share of the fund. And we are saying that this is, yes, it is a security. We're compliant with SEC. We'll talk about that a little bit later. But what we're doing is our Hack tokens are essentially a share in the fund. So let's say we sell 100 million of these when it's all said and done for $1 a piece. So there's going to be $100 million in the fund, and we are going to use that money to invest into startups. So what that means is we are going to purchase stock of other startups. And in the white paper, we're committing to invest in about 30 startups for every $10 million that we raise. So if we raised $100 million, we would invest in about 300 startups. So a very broadly diversified portfolio. And we would buy stock in each one of these startups to the tune of anywhere from 1% to 20% of these companies. And so what we do then is, well, how do you know what the price of the Hack Fund is going to be when these actually start trading on online exchanges? Well, what we're committing to do is something similar to what if you had a publicly traded fund on the NASDAQ would have to do, i.e., we have to have a third party create valuations of our investments or valuations on our portfolio of companies. And then we will have those valuations audited. So we're not touching this data. We're not messing with it. We're not screwing it up. And then we are going to report that data along with the audit publicly. So let's say, for instance, we have invested in 100 companies. And we have 10% of 100 different companies on average. If these companies are essentially growing 30, 40, 50% a year, and what do I mean by growing? If they're increasing sales, if they're increasing revenue, if they're profitable, if a company grows 100% in a year, their valuation should change. And it should double roughly about 100% that year. You might discount it. You might add a little bit more depending on how you think the long-term value of the company is. But if you actually have a company that grows 100% or doubles its revenue in size, that valuation should increase as well. It should double in size. So let's say if we have a portfolio of 100 companies, and each one of those companies on average grows 30% that year, well, then the value of that portfolio, the value of that stock, the stock that we own in those 100 companies should grow by about 30% a year. This is what we've actually been seeing in our own portfolio in the previous versions that we've been doing this in the private accredited investor only portfolios that we've actually been building. They've been growing about 30% a year for the last 5 years running. And so that's really kind of the core mechanic. You buy a Hack token or you buy a Hack, and on every quarter, we'll report on the aggregate value of what we've purchased, the stock that we've actually purchased with that money. And then the market, you can buy, sell, and trade these tokens on online exchanges. Some people might think that there's room for a lot more growth over the long term, and so they might actually bid it up. Some people might think that our portfolio is terrible and that's going to crash, and so they might actually, bid it down. But essentially, the market is going to decide what the value of our Hack token is worth. And this changes venture capital in some very fundamental ways, which we're really excited about. And I'm going to talk a little bit about how a traditional venture capital fund is structured and why some of them are actually, they operate the way they do. A traditional venture capital is funded in a similar way. You get a fund, you put money in the fund, you use this fund to go out and buy stock in other companies. The problem is that as a fund investor, my money is locked, it's frozen inside of this fund, which is invested into a portfolio of 10 companies. The only way in a traditional venture fund that the investors in the fund can actually make money is if those companies in the portfolio end up getting acquired or end up having an IPO on a NASDAQ stock exchange. Those are really the only two ways where investors in venture funds actually make money. And those are very kind of rare events. You know, we've been very fortunate. We've had 7 out of the 55 companies that we've worked with have actually exited. So we've been returning money to our investors in year 5. We've actually talked with investors in traditional venture capital funds that sometimes their money gets locked up inside that fund for 10, 15, 18 years. One venture fund investor was complaining to us. He's like, look, I invested my money. I didn't see any return. 18 years later, my money is still locked up inside of these companies, and we really can't do anything of it. It's just frozen inside of there. And so that's really the core mechanic that we're actually avoiding, or that we're changing, is that we want our investors to be able to sell their stock in the fund and be able to essentially, if you need to buy a house, if you need to, if you have a baby and you need to save up for school or something like that, there's a way for you to be able to buy more stock if you're interested, or sell off some of your positions if you're interested. The second core mechanic, how we're actually different, is in a traditional venture fund. A VC will essentially charge a percentage of assets under management every year as a maintenance fee, as a management fee. That being said, so for instance, if I have $100 million in a traditional venture fund, I would charge the investors who put money in this fund 2% a year to actually make those investments, to operate my funds, to help our portfolio companies out, what have you. Which is fine, except these 2% management fees are every year. And if you have a fund that's 10 years long, or even 6 or 7 years long, that's still anywhere from 15 to 20% of that $100 million gets taken off the table and goes into the fund manager's pockets, which is fine. People have to make money and people have to survive. What we've decided to do on our fund, which is very different, is we are taking a little bit off the top. We're taking 8% out of the initial fundraise, and we are going to give it to some of our advisors. We're taking 3% of that. We're going to use it for our own operations, the costs that we've actually accrued. We'll probably have a couple $100,000 in costs when this is all said and done, to actually operate the ICO and for our own operating expenses. Anything that we use above and beyond that, we, as the management organization, will borrow from the fund, we will use it for our operations, but we will pay it back out of our profits at 5% per year. That is, rather than take the money in a traditional venture fund and just put it in my pockets, and that's just the cost of doing business with me as a fund manager, what we are actually doing on the Hackers and Founders Fund side is we are committing to say, look, we will use some money from the fund for operations, but before I make any profit, I have to repay you, the fund, at 5% interest. Why am I doing that? 2 reasons. One is it makes me run a cash-efficient business. It makes me essentially not spend tons and tons and tons of money on extremely expensive real estate on Sand Hill Road, and you're not going to see me driving a Ferrari anytime soon. I'll probably be driving a Nissan. If it goes really well, we'll drive a Tesla at some point. But the goal is essentially to run an organization that's very capital efficient, because we want as much money as possible from our investors being invested and growing in value. So rather than taking the money off the table, we're committing to borrowing it and repaying it at 5% interest. So rather than losing 18% out of your fund, you're going to be gaining 5% a year off the stuff that we actually use. Another step that's actually different, and I'll talk a little bit as well about, I'll actually dive into it now. Why are we doing that? There have been two really important studies that have really led our thinking when it comes to this. They're both put out by the Kauffman Foundation. One is the returns of angels investing in groups. The second study is We Have Met the Enemy and He Is Us. So the first study is when an angel investor actually invests their own money and buys stock into a group of small companies. If they can build a portfolio of 20 to 25 companies, they tend to do about 20 to 25% per year. It tends to be a really good investment asset class. It's very time intensive. You got to work with the companies. You have to find, see hundreds of companies to make 20 investments. But if you can build a process for actually doing this and doing it efficiently, it tends to be a really good investment. Venture capital, these are people who professionally invest in startups, who invest other people's money to do this. They would raise money from rich people to invest in startups. When you actually look, and the Kauffman Foundation did a study of 40 years of their own venture capital fund performance, i.e. all of the venture funds that they had invested in, they had looked and their venture capital funds had only done about 5% per year. Now, why would a venture fund do 5% per year on average when an angel investor does 20 to 25% per year on average? In my mind, the difference is a management fee. If the venture fund is charging 2% a year for 10 years, that's 20% of the money out of the $100 million or out of the fund that's getting taken off the table and goes to the managers. As opposed to angels who invest their own money don't have management fees. And so the difference between 5% per year and 25% per year is 20%, which is a 2% management fee times 10 years. This is our kind of core thesis. The previous funds that we've actually built, the last 4 funds that we've actually built, have operated in a way very similar, so that provides, much like an angel investor, a portfolio of startup stock, and it essentially gives our angel investors a tiny little slice of the 20 companies that we work with in that portfolio. And we've been doing about 30% per year. I would like to say that it's because we are such geniuses at picking the best startups. I think we're really good at it. But at the same time, there's a structural difference that changes completely the economics of how the fund actually works. The last difference between a standard venture fund and what we're doing is called the carry. How does Hackers and Founders make money over the long term with this thing? If we were going to do, Joe's venture fund or Jonathan's venture fund, and we were going to do it on a traditional model, we would take money from other people, $100 million, let's say. We would invest it into startups. We would take our management fee, 2% a year for 10 years. We would invest $80 million into a portfolio of companies. If these companies get acquired by Google, if they have an IPO, if they get acquired by Facebook, then the money that we get from those exits would go back into the fund, and then that would get shared with our investors in Jonathan's venture fund, and I would get a bit of profit sharing. So I would get 20% of all of the profits from those liquidity events, is what it said. So for instance, if we take $100 million, we invest $80 million of that into startups, the startups grow to, on average, being worth, we have couple of companies that sell, 3 companies that sell for $1 billion each, and we have 10% of each of those companies, we would have $300 million come back into the fund. So we would get our $300 million, we would send it back to our investors, but we would get 20% of the profits, or saying we would get $60 million out of that $300 million as a profit sharing, and our investors will get $240 million. That's called a carry. And the idea of the carry, why it's called a carry, it comes from the old idea of when a ship would actually travel across the ocean in ocean voyages. In the early days of the Silk Road, for instance, you would have a Dutch ship going to Indonesia, buying a bunch of spices and coming back. The people who actually invested in this to make it possible would get really about 3/4 of the profits. But the people who actually ran the ship, the captain, the sailors, they would get the profits that they carried back. They would get about 20 to 25% of those profits. And so this is a business model that's several hundred years old, and that's why it's called the carry, as opposed to just calling it profit sharing. Our fund is a little bit different. Instead of, what we're doing is, let's say we sell $100 million worth of stock. We issue 100 million shares to you, our investors. Out of those 100 million shares, we are going to have an extra 20%-ish on top of that. So an extra 20 million shares will go to Hackers and Founders Incorporated, let's call it. Now, we can't touch those shares for 4 years. That's called a vest. We cannot take money out. We cannot cash our money out of those shares for 4 years. And the only way we make money is when those shares are finally fully vested after 4 years. We have to sell our own shares in the fund so that we can actually generate profits. So the only way I'm going to make money is if the fund shares actually grow in value over the long term. Like, I want $1 a share. I want that to be worth $3, $5, $10 a share in 5 or 10 years. Why? Because that's the only way that I make money. On top of that, out of the first shares that we actually sell, I have to repay the fund at 5% interest. So let's say we have a $100 million fund. Over the first 5 years, I've spent $10 million in operating expenses. I would have to repay the fund at 5% interest, $10 million at 5% interest times 4 years. We'd have to repay that to the fund before we were actually able to take any of that money and put it in our pockets and distribute it amongst our team. So it's a very long-term way of actually thinking. What happens when one of the companies in our portfolio in the Hack Fund actually exits? Let's say we have one of those companies, we own 10% of it, and it gets sold to Google or Facebook for $1 billion. We would have $100 million, because we own 10% of that, we would have $100 million come back into the fund. And then what do we do with that? Instead of paying it out to all of the investors in the fund, what we're doing is we're taking that $100 million and we're reinvesting it again. And so we would have the $100 million on top of the stock and the other 99 plus companies that we've already invested in. So this is called an evergreen fund, meaning the money in the fund keeps growing and growing and growing as long as the investments, the companies that we're investing in, grow in value. Over the long term, this fund will grow in value, and it will be an evergreen fund. It's going to be very similar, if you're familiar with Warren Buffett, it's going to be very similar to the type of investment that he has actually made in this fund, this company called Berkshire Hathaway. He buys companies and he holds on to them. He bought Geico back in 1950-something, and Geico is so profitable that he bought the whole company and he just hung on to it. And he made a ton of money off of that. And it's been that money that he uses to go out and buy other companies and buy other companies and buy other companies and invest. And now it's, his stock is something like $150,000, $180,000 a share. I haven't looked at it for like 2 years. But the idea is this fund, this pool of assets can grow and grow and grow and grow. Now, let's say in 15 years, we have $2 billion in this fund, and we just have no idea what to do with it. What we can actually do as a fund is we can actually buy back the stock. We can buy back the Hack tokens in the fund. And so that would actually drive the price up of the fund, and we would have less and less cash in the fund, but we would also have a reserve of our own stock. That way, we actually have a little bit of influence over the long term about the price of this fund. Another reason that we have that kind of core, that buyback mechanism, is let's say our third-party valuation says that the 100 companies that we've invested in, and the stock in all of those companies is now worth $200 million. So if there's 100 million shares, there's 200 million, it's worth $200 million. Each share should be worth $2 a piece, right? So, but what if these shares are trading at $1.50 a piece? So the shares are trading less than what's called the net asset value, than the value of the entire fund. That, in our mind, is an excellent time to actually buy the stock, because you're buying $2 worth of stock for $1.50, right? And so we're also reserving the right to, if, for instance, something happens, Bitcoin crashes, a lightning strike hits, Silicon Valley, it falls off into the face of the ocean, what have you. The fund actually has the chance, and the entire cryptocurrency market, Bitcoin, Ethereum, everything absolutely tanks. The fund actually has the ability to buy back its stock to support the price. And we are committing to only do that if we feel it's in the best interest of all of our shareholders. Now, remember, we don't see any money out of this thing until we actually can sell our own stock. And so we're actually playing a very long game. So the core fund is different from traditional venture capital. Just to sum up, it's different to traditional venture capital in a number of different ways. The first is we're selling $1 a share to start with. There's a discount right now during the pre-sale. Those shares are going to be bought and sold on online exchanges, not in the United States, but they will be on offshore exchanges because we're compliant with the SEC rules. And people will be able to buy, sell, and trade these much like you would buy an Ethereum or a Bitcoin or a Litecoin or a Dogecoin. You can go online, you can buy these online. And then you can actually, in the same exchanges, you'll be able to sell them. We take the money that you've actually invested with us. We buy stock in a whole bunch of companies. We help those companies grow in value. And over the long term, as our companies grow in value, the price of the stock in the fund should grow in value. If it doesn't, we can buy back some of our own stock to make sure that the price is going up. And that stock would stay with us. If the price is very high, then we can sell a little bit off as well. But we can do that to tie the value of the assets that we have in this pool to the value of the stock. We are also going to be auditing the valuations, third party. That's going to be public, so you'll be able to see very transparent all the stuff that we're using for our expenses. We're going to actually, provide, this is what we spent throughout the year. These are, what our expenses have been, and this is what we're actually committing to paying off at 5% interest when it's all said and done. And then when one of our companies exits, rather than take the money out of the fund and share it back with the investors, what we're going to do is we're going to actually invest in more startups. So this pool of startup stock, this pool of small companies, the idea is to buy stock in these tech companies at the lowest possible price, work with these companies to grow in value over the long term, and then if a company launches an IPO on the stock exchange, well, the stock that we bought at $1 a piece might now be worth, $1,000 a share. The first dollar that was invested into Airbnb last year was worth about $80,000 for every dollar in. So if you have a portfolio of 100, 200, 300 companies and you pick up one or two Airbnbs, the portfolio does really pretty well for itself. And that's kind of what the venture game is about. The difference that we're doing is we're also going to be reporting the values of the rest of the companies. And so investors can buy, sell, and trade as the fund is actually growing over time. Those are really the two mechanics. The reason why we're doing this is we think that there's got to be a way to invest in profitable companies. There's got to be a way where we can create a fund, and this is the way, where we can create a fund where we can invest in companies, and we don't have to force these companies to flip to Google. Our portfolio founders aren't going to build companies to flip. They're actually going to build great companies. We're going to evaluate those companies on their ability to produce revenue, their ability to grow over the long term, and their ability to, be transformational. But we're very interested in companies that are growing, selling, solving real problems, and are adding a lot of value into the ecosystem and really growing economies. The other thing that this really excites me about is this lets us invest into companies that other venture capital funds just can't touch. Our model is fundamentally different. It allows us to invest in geographies that other venture capitalists can't touch. For instance, one of the reasons why so many companies are invested in Silicon Valley is because there are so many companies that are acquired in Silicon Valley. 85% of all of the tech companies in the world that are acquired get acquired in this 100-kilometer region of the world called Silicon Valley. So when those companies are acquired, their investors get rich and they make money. If you're in Buenos Aires and you can't get acquired, if you are in Greece, you can't get acquired. It's very hard for you to get acquired. So your chances of raising money are very slow. We're going to be able to invest in companies from around the globe where other people can't invest, and we will be one of the only people who can actually profitably invest in these parts of the world, which is why we're really excited about it. Because Hackers and Founders is this global community. It's people helping each other out, helping build startups together, supporting each other, getting together on a regular basis for events. And now we're actually offering to the community the chance to actually be able to invest as little as $1 or $20 or $50 or $20 million. You can invest as little or as much as you want into this fund. And if you don't like how it's going, you can sell. If you need to do something else with your money, you can sell. If you're interested and excited, you can buy more. But we're really excited because it's going to be the community that's actually going to be investing in the startups that are coming from our own very community. And this is, in my mind, the ultimate in crowdfunding. It is a crowd investing in a crowd of companies. And in my mind, that's the right way to do it. Rather than just letting extremely rich people invest into companies and pray that they get acquired by Google for billions of dollars, ideally, we would have 10,000 people investing into this fund, and they can be tweeting and retweeting and supporting and sending emails for anything that actually happens with one of our portfolio companies. Why? Because we're all invested and we all have an interest in the success of this pool. So we have the community has an interest in the success of the companies. The founders have an interest in the success of the companies. Hackers and Founders has an interest in the success of the companies. And in my mind, that's what they call turtles all the way down. It's everybody's incentives are actually aligned so that we can all actually make the world a little bit better place together, investing, supporting, and helping each other out together over the long term. And that feels very Hackers and Founders. It feels like the right type of collaborative capitalism that we actually need. There's a lot being said about Silicon Valley and how it's just rampant, capitalism, pillage, kill, blah, 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 like Wall Street, kind of like Wall Street, the corporate raiders idea. But I think that we actually need to let the community participate and join in the success of these startups that came from our community. And so that if we all win, if we all get wealthy, we do this together. And so that's it. That's my presentation. If you guys have any questions, follow us on our Telegram channel. Connor, if you're there, if you could actually put the link to the Telegram channel in the chat, or maybe when we do this video and post the video, we can have a link to the Telegram, a link to the website, and that sort of stuff, so that people can, if they want to follow up, they can ask us questions through there. But thank you guys very much for your time. Thank you for your patience. Thank you for your interest in Hackers and Founders and with the Hack Fund. And let's go out and kick a little ass. Have a great day. Cheers.